This TradingView indicator that I recently came across is designed to help traders identify potential momentum shifts in the market. It can be used to spot possible entry and exit opportunities by combining indicator analysis with price action through a concept known as divergence. To get started, head over to TradingView, open any chart, and click on the Indicators tab. Then search for Squeeze Momentum Indicator, which is created by Lazy Bear. Once you add it to your chart, it will appear below your chart in a default form. So we're going to use this indicator to identify divergence setups, which can highlight areas where market momentum may be changing. Now, if you are not familiar with divergence, don't worry, I'll explain exactly what it is and how it works in just a moment. But before we do that, let's take a quick look at the indicator settings. If you open the settings menu and go to the inputs, you'll notice there are only 4 main options that affect the indicator's calculation. These settings can be adjusted depending on the asset and time frame you're analyzing. When the oscillator is red and below its midline, it generally suggests that bearish momentum is dominant. During these periods, price is often moving lower as sellers have greater control of the market. On the other hand, when the oscillator turns green and moves above the midline, it implies that bullish momentum is strengthening. During these phases, price may begin forming higher highs and higher lows, and buyers become more active. In simple terms, the oscillator tends to switch colors around the midline as momentum shifts between the bullish and bearish conditions. Now here's where things get really interesting. Take a look at this chart. Price is making lower highs, which tells us that the overall trend is still bearish. The market structure is pointing downward, and based on price action alone, you would expect that weakness to continue. However, if we look at the oscillator, we notice something different. The oscillator is actually making higher highs. In other words, the indicator is not confirming what price is doing. This disagreement between price and the indicator is what traders call divergence. Divergence can sometimes act as an early warning that momentum is changing and that the current trend may be losing strength. It doesn't guarantee a reversal, but it can alert to pay close attention to what happens next. In this example, shortly after the histograms moved below the midline and turned red, price began moving lower and a bearish reversal developed. Looking back at the chart, this would have been a setup that some traders may have considered for a short opportunity. Let's look at another example. In this chart, price creates lower lows, which tells us that the overall market bias remains bearish. Based on price action alone, the trend appears to be continuing downward. And once again, the oscillator is telling a different story. Instead of making lower lows along with the price, the red histogram bars are forming higher lows. This creates a divergence between price action and the momentum indicator. Whenever price and an indicator start telling different stories, traders often pay closer attention because it can signal that the current trend is weakening and that market conditions may be changing. Just look at what happens later in the move. Towards the end of the trend, price forms a lower high, suggesting that downside pressure could be returning. At the same time, the oscillator is making a higher high. Once again, we have a divergence between price and the momentum, and shortly afterward, price starts moving sharply lower. Of course, divergence should never be used in isolation. Like any technical tool, it can produce false signals. So this indicator can become even more powerful when combined with basic price action concepts. Instead of relying on a single signal, traders often use tools such as pivot points, trend lines, Fibonacci levels, chart and candlestick patterns to add extra confirmation to their setups. The goal isn't just to predict the market, but to build a stronger case before considering a trade. Let's look at an example. In this Ethereum 15-minute chart, you can clearly see a divergence forming. Price is making lower lows, while the oscillator is making higher lows. On its own, that divergence implies bearish momentum may be weakening. But still, I wouldn't jump into a trade immediately. Instead, I want additional confirmation. If we draw a resistance level from the base of the previous move, we create a pivot area where price has previously reacted. As price develops, the candles eventually break above that resistance level. Shortly afterward, we get a pullback into the breakout area. At the same time, the histograms turn green, providing additional confirmation that momentum may be shifting in favor of the bulls. When multiple factors start aligning, a divergence, a breakout, a successful retest, and improving momentum, it can create a much stronger setup. Now let's look at another example. In this chart, price is making higher highs, while the oscillator is making lower highs. Once again, we have a clear divergence between price and the momentum. We want to start looking for confirmation. One way to do that is by drawing a trend line underneath the uptrend, connecting the higher lows. If that trend line breaks, it could provide evidence that bullish structure is weakening. We also have a support level that was previously holding price higher. Once that level is broken and begins acting as a resistance, it adds further bearish context to the setup. When price eventually breaks both the trend line and the support area, some traders may view that as a confirmation that market conditions are changing. At the same time, the histograms turn red, showing that momentum is also shifting to the downside. This combination creates a much stronger bearish case than divergence alone. Now, if we want to add one more layer of confirmation, we can combine the setup with another indicator. It doesn't have to be anything complicated. Even a moving average can help provide useful information about trend direction and breakout strengths. To do that, go back to the Indicators tab and search for EMA Ribbon, which is created by FSCrypt. Add it to the chart, and you will see it is attached to the candles. If you open the settings and go to the inputs, you will see multiple EMA values. This indicator combines 8 exponential moving averages into a single tool. One thing I like to do is increase one of those EMA values to something higher, such as 200 or 300. A longer-term EMA can help identify the broader market trend and highlight important dynamic support and resistance areas. You can also customize its appearance in the Styles tab to make it easier to spot on your chart. Now let's see how this can improve our setup. In this example, price breaks above the EMA ribbon. This shows that bullish momentum may be strengthening and that we should start paying attention to potential long setups. At the same time, we have divergence. Price is creating lower lows, while the oscillator is creating higher lows, giving us our second layer of confirmation. As the move develops, price interacts with the 300 EMA and finds support before moving higher again. The breakout above the EMA ribbon provides another piece of confirmation, helping us build confidence in the overall setup. Some traders prefer waiting for an additional price action trigger. In this case, price breaks above the resistance, pulls back to retest the level, and then continues higher. Of course, no setup works every time, which is why confirmation and risk management are so important. The nice thing about this example is what happens after the initial move. As you can see, price pulls back towards the EMA ribbon. However, the 300 EMA is acting as a strong support area. The price is able to hold above it. Since histograms remain green and continue to imply bullish momentum, some traders may view a move back above the ribbon as a potential area of interest for re-entering in the direction of the existing trend. Now let's move on to our final example, which focuses on a potential short setup. In this chart, we can clearly see a divergence forming between price and the indicator. As the setup develops, since this longer-term EMA is often used as a trend filter, some traders may interpret a move below it as a sign that the broader market direction is becoming more bearish. At the same time, the histograms turn red, providing additional confirmation that momentum is shifting to the downside. Another important detail is that we already had a support level created by the previous trading range. Once price breaks below both the support area and the 300 EMA, multiple pieces of evidence begin aligning in the same direction. As the move continues, price eventually pulls back towards the EMA. For traders already participating in the trend, this type of pullback can sometimes become the area to monitor for a potential continuation setup, provided their trading rules and risk management criteria are still satisfied. If you would like to learn more about this EMA Ribbon indicator, I've already made a full tutorial dedicated to it. I'll leave a link to that video in the description below. Make sure you check it out because it covers the indicator in much greater detail. And before you go, I have to announce that I'm not a financial advisor, and this is not a financial advice. All content, information, and opinions shared in this video are for educational and entertainment purpose only.